K. Suresh, President of Association of National Exchanges Members of India, and Dheeraj Relly, Managing Director and CEO of HDFC Securities, join us right now on the show. Gentlemen, thanks so much for joining in, Dheeraj. Just want to understand what is your sense, because I think different brokerage houses have also given it a slightly different color to of the overall impact, but key being banks get a play, and brokers and other intermediaries now have heightened competition and probably going to lose out.
See, there is no significant impact on the client-based brokers. The impact is only brokers who are largely transacting in the prop book only. So client-based brokers who are listed, unlisted, hardly any impact on them. This was the practice where they have to give the 50% kind of a margin for bank guarantees, and out of that, 25% in the cash. So that's absolutely remaining the same. The impact is on the prop brokers. Now they have to give 50% cash and 50% in cash and cash equivalent, which means that they will have there are issues. Their impact cost will increase, their borrowing cost will increase, and this will impact the liquidity, impact cost, and spreads in the F&O space. So 40% of the F&O volume is done by the prop brokers. That's where there are concerns. So we expect that overall market F&O volume should come down close to 15 to 20% effective 1st April. And it's a culmination of STT increase and now this RBI circular, and also the earlier measures taken by the SEBI. But there are some plus of this circular also. Now banks can actually lend for the MTF purposes also. In fact, it clarifies what are collaterals that can be accepted and what are the haircuts that will be applicable. These were not clear. So the circular is providing only transparency and clarity. There are no significant impact on the client-based brokers.
Just a couple of points on that point, and good morning to you, Alex, here. The assumption is in a certain number of pockets that this will lead to a certain extent to consolidation in this space. The relatively smaller players will be unable to operate at scale. Is that the right interpretation?
I don't think so. It will lead to any kind of consolidation, because those brokers who are essentially trading in the prop book, they are trading in their own money only, they are transacting in their own money only, and they are not accepting client funds, and they are not trading on behalf of clients. So there, I don't think so they will migrate in any case, or the client-based brokers who would be interested in taking over some of these prop brokers. Client-based brokers also have a choice to do the prop book of their own, and some of them have been doing also. To that extent, some of them will get impacted, but most of the client-facing brokers have very limited prop book, and hence the impact will be very limited on them.
K. Suresh also with us this morning. He's president of ANMI, that's the Association of National Exchange Members of India. Mr. Suresh, very good morning to you, and thank you for your time to NDTV Profit. Just trying to understand the impact that you see of the RBI guidelines coming in for your business overall. What extent of business do you think gets impacted? Because now there needs to be more hard cash to execute trades compared to earlier, isn't it?
Yeah. This new regulation actually changed the whole scenario. Earlier, it was a leverage-based approach by the banks. Now it is totally a structured model has been given to the banks to implement loans to intermediaries. The most important thing is that here we are not against this model, but we are against some of the intricacies involved in this. For example, 40% haircut for shares, that is a very, very high margin, which is actually we have to reconsider that limit. Similarly, 10% collateral for normal funding. See, earlier we were under the general credit policy. Now we are under specific policy given by the Reserve Bank of India, which means we are totally focused. One way it is good, but the other way, removing prop trade from the funding itself, or similarly market making also, stock inventory is not considered for market making entities. That will also affect the liquidity. See, finally, where it boils down is that you are hitting somewhere and it hits the market also. It is going to have a effect in the volumes of F&O. Similarly, it is going to have an effect on
To
the
what
pricing.
extent, Mr.
I mean,
Suresh? To what extent?
around my view is that volumes will go down by 30% minimum. There's no doubt about it. Similarly, the price, discovery of good pricing also will be affected. Particularly market making also you are touching. And another one is that working capital requirements of our community. See, please understand that brokers, totally we are having different types of brokers, top brokers, medium level, small brokers. If you see the composition of this, most of the brokers are medium and small only. Only fewer top brokers are available. Of course, who are rather managing 80% of the volume, no doubt, but who is managing 80% of the investors, the small and medium brokers only. So your financial inclusion, if at all you want to grow further, you
So
have to
Suresh, just trying to
remodel.
understand, on average, what is the extent or what is the volume that each broker, and you're talking about small and medium brokers, what is the volume of business which comes in with these leverage-backed trade facilities? How many investors are actually, or how many clients are actually going in for all of these options? Is it a large number?
See, that's what I'm saying. Volume-wise, it may not be large numbers, but number-wise, investors, small investors, we are only doing the last mile connectivity with the investors is from small and medium only, not the top one. Top one takes care of high volume trades, algo trades, etc., etc. So the normal trades are taken care only by the small level and medium level players. For them also, working capital requirement will be there. See, earlier we are having high leverage against our equity, but when you brought down that to by introducing collateral, 7% collateral, and also within that 40% haircut for shares, I mean these things definitely cripple availability of funds, and it will force the medium and small enterprises to bring in more and more capital into the system, which is also very difficult in a setup like this, in a model like this. Bringing more capital is not that easy as we think, because it's a marginal. I mean, the margins in this business are not that high as everybody thinks. Margin is very, very thin margin business. So that's why it is our view that we have to sit with, Reserve Bank of India should sit with association like us and find out a way out to implement this model, but with some modifications. That's what we want.
Okay. Both of you gentlemen have spoken about this equity collateral 40% haircut, and that seems to be a sticking point beyond what the implications are for prop traders. Last word from you, Dheeraj, on this particular point. Is this the most painful point in your opinion?
No, there was no clarity on the haircut. So what essentially this circular does is to provide clarity what you can take as collateral and what haircut you can take. Earlier also banks were taking the haircut only. Nobody provides loan against shares 100%. So in any case for a retail customers up to 1 crore now, they take haircut of 50%. Most of the NBFCs who lend it to promoters also do the haircut of at least 40%. So I don't think so. This is a big bone of contention. The thing is that earlier the clarity and transparency was not there. Now there is a clarity that what it entails for the client-based brokers, what it means to the prop brokers, and now there are some more funding options are also getting open. Let's say you can non-MTF trade receivables. Client owes you money, you can borrow against that also. There is earlier banks were not lending for the margin trade facility. Now banks can lend for margin trade facility also with some terms and conditions. Earlier all brokers were approaching only market participants and going through the CP routes only. So that's over 1 lakh crore market for the banks to get opened. Of course, it will take some time. They'll also go through the details and come out with a offering on MTF side.
Sure.
So my take is that it is bringing in a lot more clarity. One more thing
Do you think there'll be a 30% drop in volumes, as K. Suresh is saying?
I have already said, Tamanna, my take is that it will impact 15 to 20% of the FNO volume only. It's not just because of the RBI intervention or RBI circular. It's culmination of RBI action, STT increase, and
Sure.
earlier steps taken by the SEBI.
Sure. And the one point you wanted to make, Dheeraj.
Yeah. So if in a normal course of business, you want to, let's say, take a new office and you provide 100% collateral that as an office, you can borrow as a normal, normal borrower. So that will not be counted as a capital market exposure. In any case, banks are not short on the capital market exposure. So to that extent, I don't see any significant impact on the capital market exposure of the banks.